If you type the question into a search bar, most retirement calculators give you the same answer for pulling $100,000 a year out of your super for 25 years. $1,650,000. That number comes from a simple 4% drawdown rule, and on paper it looks tidy. Those calculators leave one thing out. The age pension in Australia isn't a smooth slope, it's full of cliffs. Once your assessable assets cross a certain line, having an extra $10,000 sitting in your account can quietly cost you around $780 a year in government support. Stack that up over a couple of decades, and you could be walking away from more than $50,000 in payments you were entitled to, simply because nobody showed you where the cliff edges sit. So the standard advice, chase one big static number and hope for the best, can actually work against you. A couple sitting on $1,100,000 might end up more financially secure in retirement than a couple sitting on $1,300,000 once you factor in how the pension system responds to your balance. Today, we're walking through the 2026 version of this math, the caps, the thresholds, and the deeming rates that changed this year, and exactly how to draw down your super so you hit that $100,000 a year without the system quietly working against you. If you're between 55 and 65 and you don't want the government to means test you out of the retirement you spent 40 years building, stick around and subscribe to Aussie Retirement with Bob. There's a lot more to this than one number. Most people assume that pulling $100,000 a year means you need $2,500,000 sitting in super, because that's what a flat 4% drawdown would suggest. That's not actually true for most homeowner couples in Australia. Once you factor in how the age pension phases in, the real number where your super starts working efficiently sits closer to $1,100,000. I've watched people chase that $2,500,000 target for years, cutting back on things they could easily afford, because nobody told them the government was going to help fill the gap. That's the first reversal worth sitting with. More super doesn't always mean more retirement income. Sometimes it means less. The mechanism works like this. Services Australia runs something called the assets test. For a homeowner couple, you can hold up to $499,000 in assessable assets and still receive the full age pension, worth around $47,070 a year combined. Go over that line, and for every extra $1,000 in assets, your pension drops by about $78 a year. It's a slow bleed, not a sudden cut, but it adds up. And that distinction matters more than it sounds, because it means one strong year in the share market, or one lump sum you didn't expect, can nudge you into or out of thousands of dollars of pension without you actually doing anything. This is where the trap sits. Somewhere between $500,000 and $1,100,000, you're in what I'd call the taper zone. Your super balance is growing, which feels good, but every dollar it earns is quietly working against your pension at the same time. It has to do double duty just to keep you in the same place. Building your super too far past that cliff without a plan carries a hidden cost. You end up self-funding a bigger slice of your own retirement than you needed to for years on end. And that's money you can't get back once the window has passed. Let's put real numbers on it. Picture a couple sitting right at $1,100,000, just past the point where their pension hits zero. They spend $100,000 that year, so their balance drops to $1 million. Suddenly, they're back under the taper ceiling, and they qualify for around $8,000 a year in age pension. Their super only had to provide about $92,000 of that $100,000 lifestyle, not the full amount. Now, stretch that same couple to $1,200,000 instead. They're still getting zero pension, but they're carrying an extra $100,000 in assets to manage invest, and worry about. I call this no man's land, and it might be the most awkward balance to sit in on the way into retirement. We'll come back to why in a moment. So how do you actually use this instead of just avoiding it? The strategy I'd call drawdown deceleration flips the usual advice on its head. Rather than taking a cautious 6% or 7% from your super every year, to slowly work toward $100,000 you spend more in the early years, on purpose so your balance drops into the pension zone faster. I used to tell clients to preserve their capital at all costs. I was wrong about that, at least inside the Australian system. Spending your way into a part pension is often the most mathematically sound thing you can do, because it's not really spending money away. It's trading super balance for a lifetime income stream that's indexed and doesn't run out. There's a reason this works in your favour as much as the government's. Age pension payments are indexed twice a year, in March and September, so that portion of your income keeps pace with the cost of living without you having to manage a single investment. Every dollar of pension you unlock is a dollar of your own super that gets to sit there longer, still earning, still available if you need it for something unexpected, like a new roof or an aged care top-up. Picture a couple starting retirement with $1,300,000. Path A is the cautious one, a flat 4% draw, about $52,000 a year, topped up eventually by a part pension once the balance falls far enough. Path B is the $100,000 target, drawing the full amount from year one. It feels riskier on paper because they're spending nearly double. But by year 5, Path B has already dropped well below that $1,100,000 cliff and is collecting somewhere around $23,000 a year in age pension. Path A, still cautiously sipping $52,000 a year, is barely into the taper zone and might be seeing closer to $5,000 a year in pension. That's an $18,000 gap every single year just from the pace of the drawdown. It also means Path B spends fewer years worrying about outliving their own money, because a bigger slice of that $100,000 lifestyle is coming from a source that's indexed and never runs dry. Playing it too safe here carries a cost nobody really talks about. It can cost you real pension entitlements for years, entitlements you never get back once that window closes. Conservatism has a price tag too. It just doesn't show up on a bank statement. Think about what unlocking an extra couple of $1,000s a year actually buys. It's the difference between dreading the car Joe renewal and just paying it without a second thought. Of course, none of this works if the market falls over in your first year of retirement. Timing matters just as much as the strategy itself, and that's where a lot of well-intentioned plans come undone. Getting the sequence right is what separates a couple who lives comfortably off this framework from a couple who has to abandon it halfway through and go back to scraping by on the cautious path. Let's pressure test this. Say the market drops 15% in your first 24 months of retirement, which is exactly the kind of thing that tends to happen right when you can least afford it. This is called sequence of returns risk, and it's one of the few things that can genuinely wreck an otherwise solid retirement plan. The reason this hits retirees harder than someone still working is simple. When you're adding money to super every fortnight, a downturn means you're buying in cheap. When you're pulling money out every fortnight instead, a downturn means you're selling cheap, and there's no next paycheck to average it out. The math runs in the opposite direction once you stop earning. Picture someone who hasn't planned for this. They're drawing $100,000 a year. The market falls, and they keep selling units out of their balanced fund anyway. Because the bills don't stop just because the market did. Every unit they sell during the downturn locks in that loss permanently. A downturn like that, early in retirement, combined with selling to fund your lifestyle, can shorten how long your money lasts by something like 7 years, simply because you sold low instead of waiting it out. The fix is what I'd call the 3-year cash bucket. After the 2008 financial crisis, even counting dividends being reinvested, it took the Australian share market close to 5 years to fully claw back what it lost. Measured on price alone without dividends, it took more than a decade. If you'd been forced to sell into that dip to cover living expenses, you'd have locked in the damage instead of riding it out. So before you retire on $100,000 a year, the goal is to hold around $300,000 3 years of spending, somewhere safe. A high interest account, or a term deposit, not the share market. Think of it as a recession shield. It buys you the ability to simply not sell anything while the market sorts itself out, and top the bucket back up once things recover. It's not a complicated idea, but it's the difference between riding out a downturn and being forced to realize a loss you can never get back. And even if you get the market timing right, there's a quieter threat working against your $100,000 the entire time. Inflation doesn't announce itself. It just erodes what that number can actually buy. This number is worth sitting with for a second. If inflation runs at a steady 3% a year, which sits inside the Reserve Bank's own target band, $100,000 today only buys what $74,400 buys in 10 years' time. Same number on the page, a quarter less buying power in real life. This isn't new. When ASFA first started tracking what a comfortable retirement actually costs, back in 2004, the figure was a small fraction of what it is now. Today, a comfortable lifestyle for a homeowner couple costs around $77,375 a year, according to ASFA's most recent figures, and it's been revised upward practically every quarter since they started measuring it. Costs don't sit still just because you've stopped working. You don't need ASFA's numbers to feel this yourself. Look at your own electricity bill or your council rates notice from 5 years ago next to the one sitting in your letterbox now. Nothing about your house changed, but the number at the bottom did, and that's inflation working exactly the way it always does, quietly and constantly. There's another change worth knowing about for 2026. The government uses something called deeming rates to estimate how much income your financial assets are earning, whether or not that's what they're actually earning. Those rates were frozen for several years, and they've now stepped up to 1.25% on the first portion of your savings and 3.25% above that. In plain terms, Centrelink now assumes your money is working harder for you than it did during the freeze, and that assumption can shrink your pension even if your bank balance hasn't moved an inch. For a couple with, say, $200,000 sitting in savings and investments, that step up alone can lower their assessed income enough to matter, even though not $1 of it actually changed hands. So you're fighting inflation on one side and a slightly less generous income test on the other. The obvious question is how you get more into the system to offset both of those pressures while you still have income coming in to do it with. None of this math matters much if you can't actually bring yourself to spend the money. A lot of Australians in their late 50s and 60s run into something I'd call frugality fatigue. You've spent 40 years watching that super balance climb, and somewhere along the way it started to feel like a scoreboard. Watching it go down on purpose feels wrong, even when it's exactly what the money was for. If your stomach drops a little seeing your balance fall by $20,000 or even $100,000 in a single year, that's a completely normal reaction. You weren't trained to spend. You were trained to save for decades, and that habit doesn't switch off just because you've hit retirement age. I've seen people do this without even realizing it. Delay a trip they can easily afford. Put off fixing something around the house. Not because the numbers say no, but because some old instinct is still running the show. The plan can be perfect on paper, and still fail if the person behind it never gives themselves permission to actually live on it. One shift that helps is thinking about your super balance less like a score you're trying to protect and more like a lifestyle you've already paid for in advance. Every dollar that leaves that account is not a loss. It's a holiday with the grandkids. It's the roof getting fixed before it becomes a problem. It's a Medicare gap payment you didn't have to stress over. The invoice gets paid either way. The only question is whether you let yourself use what you built it for. If any of this sounds familiar, you're not alone in it, and it's worth talking through in the comments below. I read them. Subscribe if you want to keep working through these Australian-specific retirement questions together. If you've got 5 or so years before you actually retire, there are a few concrete moves worth making now, while you still have income to work with. First, use the concessional contributions cap properly. It sits at $32,500 a year from the start of the 2026 to 2027 financial year, up from $30,000 the year before, and every dollar you put in through salary sacrifice gets taxed at 15% going in instead of your marginal rate. Second, if your total super balance is under $500,000, look at the carry forward rule. It lets you use unused cap space from the last 5 years in one go, which is useful if you've had a bonus, an inheritance, or the sale of an asset land in your lap, and you want to get it into super tax effectively instead of it just sitting exposed. Third, and this is the big one for anyone 55 or over selling the family home, the downsizer contribution. You can each put up to $300,000 into super from the proceeds, $600,000 for a couple, and it doesn't touch your normal contribution caps at all. That single move can shift a couple from sitting awkwardly above the pension cliff to comfortably below it, resetting all the efficiency zone math we walked through earlier in one transaction. The transfer balance cap has also moved up to $2,100,000 this year, which is simply more headroom to shift super into a tax-free pension account once you get there. So $100,000 a year in retirement is genuinely achievable for a lot of Australian couples, but it was never really about parking one static $1,650,000 somewhere and hoping. It's about understanding where the pension cliffs actually sit and using this year's caps and thresholds while you still have the chance to. You don't need to be a math genius to get this right. You just need to know that the system is built with a floor under it, one that's designed to catch you as your balance comes down, as long as you understand how it works before you need it. That's really the whole game, knowing the shape of the system early enough to work with it, instead of finding out the hard way after you've already retired. I'm Bob. This is Aussie Retirement with Bob. And if this helped make the picture a bit clearer, stick around, subscribe, and I'll see you in the next one.